Google Alphabet will be reporting earnings today, October 24, after the market closes. And so in this video, we will analyze the unusual options activity data and show you how we are trading Google for earnings. So without further ado, let's get right to the data. In the options time and sales tape, we can see here that today's biggest trades were these 5,000 unusual options done at 10:49 at the 4-second mark. So these were expiring November 17. They were selling the 145 strike call, selling the 125 strike puts, and buying the 160 strike calls. So what does this all mean? Let's analyze this. Get right to the options chain, November 17. We can see here that the 125s strike puts are over here. We see that the open interest is 15,000. That's greater than the 5,000 volume. So these could potentially be closing trades. So keep that in mind as a possible scenario. If you've been following this channel, you know how this is an important way for us to interpret some of that data. And so when we analyze for earnings, though, we want to actually analyze it as opening trades because we believe that these trades were being placed for a directional trade for earnings, that they were opening these trades, not necessarily closing them, especially since they sold 2 options instead of 1. They sold more options than they bought. And selling options right before earnings is usually the best thing to do because you collect the highest amount of premium. Now notice here the 145 strike calls that they also sold. Open interest at 17,000. Okay. On the 160 strike calls where they bought this, also the open interest is 7,900, which is greater than 5,000. Okay. So by adding these to our trade now, selling this 145 strike call, and then buying the 160 strike call, we can now analyze these 3 options. And here it is. You can see here that on the upper end here, where the stock price is here on the x-axis, this is Google stock price on the x-axis, here this part looks like selling an iron condor. And here looks like selling a strangle because this is undefined risk here. This is defined since there is a limit to the loss here. And you can see here that this is the profit loss here at the 0 here. It's over here on the y-axis. So anything above this 0 is profit. So what they're doing here is they are selling the volatility. Okay, so let's zoom in a little bit more and we can see the break evens right over here at expiration. This is the break even at expiration. This is on the upper end and this is the lower end. So what is that? On the lower end, as long as Google does not drop below 121, this is the price here, 121, or it does not rally past 148, around there, this trade will be profitable. So anywhere the stock landing, anywhere from this price range all the way here to here, this is going to be a profitable trade for this trader. Now this trader, to put on this trade, right, you can see that the buying power here, just for one contract here, requires 12,500 by selling those puts naked here, and also selling this 1,500 buying power for these calls here. Okay, because it's a 15-point wide, that's 1,500. Now if you add that buying power up, you can see 1,500 plus 12,500 is 14,000 buying power per contract. And we know they did 5,000 contracts. So we multiply by 5,000, and now you could see the total value of this trade, $70 million. So this is an institutional wealthy investor or trader, maybe even an individual, but we know they had to have $70 million of capital to put on a trade like this. Now, is this trade bearish or bullish? We can see here that it is a mix between the two, right? It is skewed, however, slightly by looking at the delta, skewed a little bit to the bearish side. That is why there is a negative 18 here. Okay. That's not a completely bearish, very bearish position here. This is still considered a more neutral strategy. Okay. And you can see that part of the reason why they put on this trade is because they're taking advantage of the earnings event with a positive theta gain here. This is good for their trade, options trade, and a negative 16 Vega, which is also very good for their earnings trade because volatility will contract, it will go down, and so this negative Vega will help their trade become profitable. It will move the profits up. Okay, so this is how these wealthy traders use options to their advantage to profit from earnings events. And so because this is more of a neutral strategy, we also traded with a slightly neutral strategy as well by taking both sides, bearish and bullish. And so that is how we will be trading that. You can see here our positions. This is the October 27th, expires in just 3 days. Very short earnings trade. You can see here our positions. What we did was we took the put and the call sides, both sides of the trade. For the put side, we sold 2 for every of our trades, the 135 strike puts. We bought the 134 strike puts and the 137. So the ratio is a 2 to 1 to 1. And when you analyze this trade, you can see that this is our bearish side of the trade. It is a broken wing butterfly. And we added another broken wing butterfly on the call side where we sold the 145 strike calls, 2 for every trade, and bought the 143 calls and 146 calls. And when you analyze this trade, you can see that now as we combine both of these butterfly trades together, you can see what it looks like here. Right? Google at 139. If it goes down, we could profit if it hits around this 135 price here. If it goes up, we could profit a lot if it hits the 145 strike a lot, right? And so either way, if it goes down or up, we could be profitable. The only way this trade would lose would be if it stays around this price range where we currently are, this dip right here, right? So this dip over here is about this 140 price, 137 to 142. So that's the trade loss area where it is below the 0. Okay. So it is still it's a different type of strategy, not necessarily a neutral strategy, because we would not be able to profit if it stayed at the 140. This is more of a strategy where we can take a bi-directional trade where it does not cost so much. You can see that the cost of this trade is 40 plus 43. So about $83 for this trade, for one of these trades. And the potential, you can see here as we move over the mouse, could potentially make $100 here if it lands around this area. We could make some profits here, or if it comes over here, we could make also about $100, right? So that is more than 100%, because if we spent 83, making a profit of 100 is more than 100%, because this graph, this is a profit loss graph. It has already taken in account the cost of the trade already. So what you see here as you mouse over here is the profits. So as this expires on October 27, this is what it looks like here, the profit loss here, right? So you'll see here the max loss here you can see is 83, because this is how much the debit was, the max loss per trade that we spent. Okay, so this is how we will be trading Google based on the unusual options activity data that we've analyzed as of now. Things obviously there could be other data that comes up, but we didn't want to wait until the last few minutes of the day, because sometimes when we put out these videos, there may not be enough time for people to watch them and to learn. And so we wanted to get in a little earlier, but keep in mind, people do trade a lot also at the last hour for earnings. So things can obviously change. If you're interested in this type of data and our analyses on different stocks that we pick, where we can predict the stock price movement, make sure to join our membership, where we share exclusive videos for members only, and also give our members early access to the videos that we share with the public freely. All right, so that is our analysis of Google earnings. Comment below what you think will happen to Google for earnings. Will it go up or will it go down? As usual, smash that like button and encourage us to make more videos. Subscribe and hit the bell icon to get notified of unusual options activity. Take care and have a great day.